I've been getting some questions about the more basic stuff. A lot of the other videos are talking about all LVN this and that and looking at through the microscope on all this. Today we're going to keep it really simple and just talk about uptrend identification. What sort of structures do we use to show that we're in an uptrend, and then which type of uptrend we're in. So we have a couple different things here. Main topic of this video is uptrend identification, and then the different types of structures that we can use to infer whether or not we're in either A, type 1, a strong uptrend, or B, a slower uptrend. In those different uptrends, there are different trading strategies that work, and understanding your market context, what type of environment you're in, is really the first step that you need to be able to execute the trades properly. One, you need to understand the context, and two, you need to understand how to operate. This video is just talking about uptrends, uptrend identification, and the different structures that we use to define whether or not we're in an uptrend. The most basic thing that we can look at is swing highs and swing lows from a structural standpoint. So one thing that I want to mention before I talk about swing highs and swing lows is that there are, on different time frames, different trends happening. So if we look at the 3-minute chart, for example, this is a downtrend. It's a strong downtrend. But from here to here, it's going sideways. We have a new high here. This is kind of sideways, and now it's transformed into a slower downtrend, type 2 downtrend. But from here to here, there's a little bit of an uptrend. Even from here to here, this is a uptrend on a shorter term time frame in a longer term downtrend. So understand that you might be in one type of trend on, say, a 3-minute chart or a 15-minute chart, and a totally different type of trend on a 15-second chart. And understanding where different time frame trends have broken and then resumed the larger term trend is where the real opportunities lie. But back to the point that I was making before, one of the more basic things that we can look at are swing highs and swing lows, and whether or not we've made new highs or new lows. So if we're just taking a look at here, we can see very clearly that the market has stalled here for a second, and then it's broken out higher. We've made a new high. The new high implies that we have pressure to the upside, and then how far the market retraces is going to tell us what type of trend we're in. From a swing high, swing low standpoint, the most basic technical way to define this is once you have a new low and the market has not made a new low for 2 bars, so right here, 1, 2, this is now a swing low. And then we have a swing high here. The market comes up, there's a new high, and there's a pause. There's 2 bars right there. So we have a swing high and a swing low, and then another one at the same level, and then another one below here. So this is, from that standpoint, a downtrend. That's just the most basic way to infer this. You look for where the highs are that are sticking out. You can see this was a swing high here. Why? Because the market went above this, makes a new high, doesn't go any higher for 2 bars, and once that happens, this creates the event that causes this to be a swing high from that methodology. This one's pretty basic. Once you understand that concept, you really can just look on the chart and say, like, oh, this is a little bit higher than this is a little bit lower than this one here is a downtrend, and then you can draw trend lines like this. There are viable trading strategies that have to do with trading inside of those ranges and things like retracements for trend following in that, but we're not going to talk about those. We're going to use a little bit of a different tool set. One of the best and easiest trend filters to use is the failed delta level. So if you use the fixed range volume profile indicator and you set your input here to delta, if you're making new highs, you can then look to see where are these little orange bands. The orange bands are sell pressure, they're sell delta, and those should function as responsive buy areas. So if the market's going to continue from that area, like if the uptrend's going to continue, you can assume that there's trapped traders here, and that is a level that we use to buy. So you can see the market probes through this, and then it continues higher. There's trapped sellers there. What we do to identify the trend is you continue to drag this forward, and you can see right here, there's another band. There's trapped sellers there. And then how the market responds to this level tells us whether or not this trend on this time frame is intact. You can see in this case that the market comes up here, it tags this and actually goes higher, but then once it retraces below that, we have now switched out of a strong uptrend on this time frame and into a type 2 uptrend. So that theme is going to be pretty consistent, that a type 1 uptrend, every level of retracement is holding immediately. It's a strong break. When the market is responding to these levels and no retracements have happened, you're in a strong uptrend, and just for the sake of getting to the point in a strong uptrend, there's almost no reason to sell. So we'll go to today, because today was an indication of two different types of uptrends. You see one here where this is kind of a slower uptrend where there's bigger retracements. And you can see that the market comes to this failed delta level and goes a little bit further. So it's not in a very strong uptrend on this time frame. Same thing here. We come to this delta level and it goes a little bit further. Comes to this delta level, holds it for a bit, pulls back a little bit further. So this is a type 2 uptrend because it's invalidating this. But in this case, when we push above this failed delta here, it just touches it and goes. We push above this one, and there's not even any trapped sellers. Well, there are, but not from this indicator. We don't even touch this one. The fact that we're not even touching these retracement levels indicates that we're in a strong uptrend. And so this is and then we come up to here, it tags this failed delta level and then bounces there. It's going a little bit sideways after that, it pulls back down, but you can use the fixed range volume profile with the delta indicator to infer that as the market is in this type of trend, these levels should hold. And you can see, where are you in relation to this? We're way up here, type 1 uptrend. This is also surprisingly useful on a shorter term time frame. So in this case, this is just a 15-second chart, and the market comes up to this, and you see that it hits here in the failed delta level, and there's room for a scalp there. If we continue to draw this forward, it's likely that happens again. Little minor one here, this is the real level down here, it doesn't even retest it. We come over to here, there's a failed delta bar right here. The market tags it briefly and then continues up. So using multiple time frames, the longer term time frame, you can say we're in an uptrend on the 1 minute or 3 minute here as well. And then because we're not even really piercing these delta levels, we can assume that we are in a type 1 uptrend. Notice the yellow area right here. Market moves into the yellow area, bounces, and continues. In a type 1 uptrend, most people will leave money on the table by not just sitting in this position. I had a Combine account open here. I think I bought it like here or something, and I just closed it. You know, like I just walked away and then ended up closing the position somewhere way up here. So in those types of trends, trying to sell just to take profits is not the way to make the most money. Well, allegedly, you know, not investment advice, but holding those positions when you're in that type of trend, more often than not, will give you more money. From here up to here, it's like 200 points. If you would have just sat in it and not looked at it, you would have made more profit than if you were trying to overmanage that position. The next one is something I kind of found on my own. It's called a one-back high volume candle. So if the market pushes up, like we're looking down here at the volume indicator, this is a very high volume candle. A lot of times this initiative buying will fail because there's, you know, it's just a lot of liquidity gets injected up there. But then once you go above that level again to here, you look one back. So this is the next high volume candle up here. It's a push to the high. Moving below this doesn't necessarily mean the trend's over. But if we go into this high volume candle up here that we have then gone above again is an area of support that's a very strong type of support. I spent more time talking about the failed delta levels than I'm going to spend on this one. I will just say that this is a very clean way to assess your uptrends and then also where support should be. So this is a 1 minute chart, and you can see that as we've gone above that in this new high, we never really go even halfway down below this. We see the same thing as we're moving forward. So this is a high volume, I'll get rid of that drawing there. This is a high volume candle down here, high volume push up. The market continues up on medium volume, I suppose, and then once it comes back into that, it attempts to bounce. You see the push right here, the market stalls there for a second, and then once it continues a little bit below that, we can infer that, oh look, the market went sideways. The uptrend was no longer a strong uptrend at that point, and then it proceeded to oscillate around this level until the market closed for about 2 hours. That works very well on a 1 minute. It also works well if you're adding in different structures. So here's the push up. This is actually around a shorter term time frame if you're adding in like multiple structures of those candles. So you see a series of high volume candles here. This is a big initiative push. And that's actually the same candle as before. Once we start getting down into that, we can look at where's the trapped seller right there, perfect entry. Same thing here on a shorter term time frame. We see there's a big spike up from the volume candle down here. Market comes back to it. Where's the trapped seller? Be right around there. Market bounces and then continues to go lower. And then also we note that when this has broken, that's an area of resistance potentially. And if we were going to wait, if the uptrend was going to reestablish itself, it would need to clear this. And it kind of did there, but it switched into a sideways condition. But in this case, once this breaks down below, this is actually a short-term scalp because we're in a shorter-term downtrend. So like I was saying before, you can be in an uptrend on a longer-term time frame. Note that we're still above this. That's probably on the 5-minute or 3-minute, the one back from this where the high volume is, and we're still on that trend. This is the support here that we would need to break if we're looking for a major reversal. The next structure we can look at is called a harmonic. And the idea behind a harmonic is that the market will pull back a certain distance of points. So you can take a box and just draw the box and say, like, from this low up to here, what is the largest pullback? It's this length. And then you can even say, like, what's of this push, what's the largest pullback? It's from here to here. And so what you can do is assume that there are retracement buyers that are approximately that distance down. And you see that if we just move that box to the high here, entering at the bottom of that box, and which happens to be confluent with this high volume node, was an area where if we would have entered there, we would have only had 10 points of drawdown and 30 points of upside. So a 3-to-1 risk to reward ratio on how far that trade moved. So you can say that, like, the shortest term pullback on this is, we're not going very far below that, and therefore the trend is a type 1 uptrend in this. And we can do the same thing where if we measure the box, it's that long, we go from the high to the low, and right there is where the entry is. This expanded a little bit further, go from the high to the low, and that's where the entry is. So you can take harmonic entries, they do work pretty well actually, but you have to be aware of where you're at in relation to other things. And they're good entry locations, but also they're very useful as far as identifying what type of trend you're in. So you can take this biggest pullback and say, like, as long as we are not pulling back below that, there would be potentially some sort of support around there. This is more in line with the trend. We have a break above this level. So if we look and we measure with this distance here, we can still see that the market really never pulled back as far as this larger pullback here, except for right here, and lo and behold, right to the bottom of that, there were traders operating there, buying at that harmonic entry level. So you use these to say, like, this is the larger pullback in here, and then this was maybe the smaller one, and then even on a micro time frame, you can take little minor pullbacks and you just use them to measure and be aware of where these areas are, that you don't want to be selling at the market down here because it's possible support. So we've talked about harmonics, we've talked about, what else have we talked about? Swing high, swing low, fill delta, one back candles. We didn't talk about high volume nodes. The concept with high volume nodes and how, if we're using them to infer the health of a trend, in order for a trend to be healthy, there needs to be more participation at a given level. So if volume is dwindling as we go to an area, then it implies that there's not as much trading activity there and the trend is possibly vulnerable. That can also imply that there's not enough liquidity to cause a reversal. But what we like to see if we use the fixed range volume profile and use high volume nodes is we like to see the volume expanding as it comes up. So we see that there's a collection of traders here. There's a lot of activity here. These little chunks here are getting fatter, you can say. This one's a little bit small. This one's getting a little bit bigger. As it continues to get bigger, the value has shifted. So the way that I have this indicator set up, it shows where the highest percent of the volume is. So the fact that this has moved from here to here implies that now trading activity is up here. And as we continue higher above that, this should be support. And so every time we're moving value higher, it implies that there is strength in the trend. So this is the area of most activity here. If we then just go to the low, we can see that as we start to drag this forward, value has moved up here, and then it has continued. This is better for identifying type 2 uptrends or really just general trend health. But as we see that the market moves up here, value has not shifted just yet, but it's going to sooner or later, right there. And so we can still say that even though this is going sideways and pulling back on a longer term time frame, this is an uptrend. And there's more volume getting established up here. That also, once it sits sideways for a little bit like this, it does create problems potentially if the market begins to reverse. But the concept there is that the trend is healthy as volume is coming in the direction of the trend. And then when it continues beyond that, it's likely that this is now support because there are trapped short entries on this that are going to get liquidated as we move higher. And we'll use a longer term time frame and show that here. So if we have this whole big structure up here, we see that the volume has accumulated to a certain extent there. And then as it moves down, I know we're talking about uptrends here, but this is now a shift downward. And so selling up here is a good move. The same thing applies in the uptrend direction, but we've been in a longer term downtrend for a while. So I'm not gonna be able to find one on the longer term time frame to show that. The final piece are low volume nodes, and low volume nodes apply pressure. And then if we have open low volume nodes, the trend is very healthy and very intact. So even without using the indicator, we see that there's a little gap between these bars here. That's a low volume node. This should function as support, and it does. There's an inverted one here. So on the longer term time frame, we're in a type 1 uptrend. On the 15-second, we're not in an uptrend here. But once this reclaims, this is now actually very strong support, because this is a failed reversal to the downside. So using low volume nodes or fair value gaps on these trend identification areas are good. We need to pay attention to when they invert and reclaim. Like this is a perfect example. This is also the harmonic, so you have multiple levels there. And if you put multiple levels on your chart and see that there's a couple aggregating there, this should be significant support. And had you bought here, the market went from 29,974 up to here in like 100 points in like 4 minutes or something, 5 minutes, however long it is. So you can see that there's a big response from there when you have confluent trend following levels. And then once those break, those indicate a trend shift. Just another example of the open gaps. So here's a low volume node. Market goes down briefly below it and then it reclaims, and that's major support there. So the fact that it went below it at all implies that it's a type 2 uptrend. And if you had one here, for example, what's a better example? In this uptrend, you have one here, and it never really retests that. Or when it does, it responds to it immediately. So when they're open and they hold and we never come back to them, that implies type 1 breakout trading strategy. When we come back to them, it's type 1 still, but healthy. But when we go under and through them, it's type 2, which implies that we'll be looking for deeper pullbacks. But these are also failed sell levels, which in a type 2 uptrend, like this is broken up here. This is no longer, at this point where I'm moving my mouse around, is no longer a type 2 uptrend. But once we get back down to here, it's strong support. So just to review, uptrend identification, there are different strategies that you would trade in a type 1 uptrend versus a type 2 uptrend. And then all of these structures that we mentioned, swing high, swing low, failed delta, one back candles, high volume nodes, harmonic pullbacks, and then fair value gaps or low volume nodes as an indication of residual pressure. Those are all tools that you can use technically to identify the trend. The better you get at identifying market context, the easier that it will be to then, you need to know the market context in order to operate your trading strategy. So you should have a trading strategy for each different market context. Type 1 uptrend, type 2 uptrend. I'll make a video for downtrends that follows the exact same thing. It will basically be a repeat of the same structures, but in the downtrend. And the way that you trade in a type 1 uptrend is a little bit different than the way that you trade in a type 2 uptrend, but there are viable trading strategies for each type of market condition. I hope this was helpful. I know I said I was going to make it a little bit more basic. These are some basic concepts. Trend identification is one of the most important things because that tells you about overall market state and context. So hopefully this was helpful. We'll maybe get into how to operate inside of these environments. Maybe I'll put that behind a paywall or something. I'm not sure, but yeah, that's trend identification, how to identify type 1 and type 2 uptrend. Thanks for watching. Also click the subscribe button. Thank you.